Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Lisa Shalett joins us now of Morgan Stanley, joining us around the table. Lisa, it's good to see you as always.
Great to see you.
Is anxiety about tariffs distracting from fundamentals? It's a point you've made recently. Do you think it is?
I think it absolutely is. And I think tariffs are probably the single biggest thing that is distracting everybody. But I think the pace and the chaotic nature, right, of the announcements are distracting to everyone. And look, we know markets love certainty. They love predictability. We don't have that at the minute.
Is it a justified distraction? And are the fundamentals good enough to stay committed and stay the course and stay bullish U.S. equities?
I think so. Our perspective has been to pick and choose your spots, and that expectations are key here. Our preference is to go where, we think companies can beat expectations and where the expectations haven't gotten too ahead of themselves and too, frothy.
You made a point that I thought was fascinating. We talked about the long and variable lags when it came to the Fed hiking benchmark rates. We don't talk about the long and variable lags of them cutting by 100 basis points starting in September of last year. Just how much is that driving some of the optimism and the deal making and the activity that everyone's expecting from corporate America this year?
Well, one of the things that's interesting is I think, the rate cuts are certainly driving the animal spirits. We actually haven't seen year to date the level of deal making that I think a lot of people were hoping for. And that's still a bit on the come. And so, I think that certainly the 100 basis points helps. It's getting, sentiment juiced, right? So we saw small business optimism, right, soar following the election. And I think part of that was, hey, I'm going to get some rate cuts and I'm going to get, some pro-growth policy out of Washington. But it remains to be seen. And I think, to Jonathan's point, some of the chaos in the headlines is starting to cool some of those expectations. We saw, that small business optimism come off the boil a little bit yesterday. We've seen some of the CEOs, including the Ford CEO, say, whoa, let's cool our jets, folks.
There's a tension here between whether there needs to be some rate cuts, additional rate cuts for the broadening out story to really make sense, or whether the 100 basis points that we got late last year actually was plenty to get this sector driving. Which is it?
So I think it's interesting. Our thesis has been that we're in a bifurcated economy. For the most part, the large cap universe, the mega cap universe hasn't needed any rate cuts, right? Because they've locked and loaded their cost of capital, back in 2021. I fundamentally believe that the mid cap, smaller cap companies, the lower end, the venture capital, some of the private equity portfolio companies do need more than 100 basis points. So we're going to see. We're going to see where this goes.
I know you're watching for a rotation of stock indices and you like the idea of cyclicals, energy, domestic manufacturers. But what about the fact that that uncertainty of tariffs just still lingers? Aren't those the ones that are going to be the most hurt?
So it's interesting. The mega cap and large caps are so much more exposed to the tariff conversation. I mean, this is where, the mid caps and the small caps actually can get life. If, in fact, the rate cuts do, flow back to them, if, in fact, we get bank lending in more the regional banking system to accelerate to those pools of companies, I think that they can actually, kind of have a better year relative to mega and large cap companies who are going to have to struggle with their China exposure, with their exposure to global trade, and to dealing with some of the constraints of tariffs and the costs of restructuring supply chains if it comes to that.
Something else you like right now where a lot of people are hiding out, even central banks, gold. Are you adding to that position?
We are adding to gold. Our perspective is that what's going on with gold very much has to do with folks around around the world questioning the primacy of the United States dollar, right? And I think central banks around the world have begun to diversify their reserves. I think that's been one element. I think a lot of the enthusiasm, believe it or not, around cryptocurrencies is also, made people think about, well, what is, if this is digital gold, what is, hard gold? Maybe I need some of that too. Our perspective is that, given where we are with debts and deficits, given the extreme bifurcation of global FX markets, that gold will continue to outperform into a third year.
You're even wearing something to represent your strong feeling of gold.
My gold.
Your gold blazer. I am curious about whether you see that sort of questioning of the primacy of the dollar shifting into some of the overweight that you might see. We have seen over the beginning of this year anyway in European equities as well as Chinese equities actually, which have really peaked up. Are you leaning into that or leaning against it?
We are 100% leaning into this, mean reversion trade, the massive underperformance of non-U.S. Equities, we believe has reached extremes. Our best guess is that, the current administration isn't helping, right? In many ways, while it's great to pursue an America First policy if you're in America, if you're not in America, there's all kinds of incentives to find ways to protect yourself. And that may mean, creating, trade arrangements with other countries and each other where America gets locked out. Our perspective is that, this is a time when not only the combination of valuation, extraordinarily low expectations for, regions like Europe, potentially like China, the potential to surprise on the upside, and the potential for some of these countries to actually stimulate, to have more proactive central banks. I mean, Lisa, you talked about the fact that the Fed may only cut 1 or 2 times this year. It's highly likely that the ECB goes more frequently than that. It's possible that some of the central banks in, Latin America, where inflation had run hot, are going to go more often than that. And those are the kinds of things that kind of create this relative catch-up trade.
We talked about this last week. It might push these countries to do things that might be good for them. Let's see if that happens. Lisa Shalett of Morgan Stanley. Lisa, thank you. Let's turn to foreign exchange. Former New York Fed President Bill Dudley making the case for King dollar in his latest Bloomberg Opinion piece, writing the following: America derives immense benefits from the dollar's dominance, a position that countries such as China and Russia are seeking to contest. By addressing the problem of cross-border payments, the US could boost the global economy and cement its central role therein. Bill joins us now for more. Bill, welcome to the program. Lots of topics to cover. Let's kick off with this one right here. You started with a premise, so let's talk about it. The immense benefits from the dollar's dominance. Let's start there. But what are they?
Well, I think the dollar is the linchpin of global financial markets. So we get what's called the exorbitant privilege of people wanting to hold dollar-denominated assets. So that makes the cost of funding in the United States less than if the dollar was not viewed as, the key currency in the global economy. But that's not necessarily ordained forever, and there are steps we can do to make that more likely to be sustained in the future. And one thing is to make some progress on cross-border payments. Payments cross-border are extremely expensive, especially for small retail payments like remittances. They cost maybe as much as 6-7%. This could be brought down tremendously if we developed instant payment systems nationally and then linked them together. A number of countries have good instant payment systems. Brazil, India, for example. The U.S. is basically nowhere. We have 2 systems, but nobody uses them. Everybody uses cards and debit cards, Venmo or PayPal. So we need to do something to reinvigorate the U.S. instant payment systems. And then once we have that, we need to start to take steps to link it together with other instant payment systems around the world. If we do that, we can actually lower the cost of payments dramatically and cement the dollar as a key reserve currency.
Do you see the Fed actually getting on this in any capacity in the near term, considering that they have their hands full with their mandate and a lot of controversy around it?
Well, I think you need some support from the administration and Congress. The countries that have been successful in this have basically had mandates. They basically said you need to actually offer this service to your banking customers. In the United States, it's completely voluntary. And since it's completely voluntary, the two instant payment systems we have, FedNow and RTX, are basically not used by virtually anybody. So they exist. But if they're not used, then how can that be advantageous to link that into an international regime?
Well, Bill, hopefully we can continue to catch up on this as it progresses, if it does progress this year. In the meantime, the focus very much on inflation and just how the Fed's going to be responding at a time where we're going to get CPI potentially at 0.3% month over month, which would be the fifth out of the six latest readings at 0.3% or above. How concerned are you about the stickiness, and does it surprise you that we're still not seeing the disinflation that so many people were expecting?
I think it's very clear that the last mile is pretty sticky, and one reason it's sticky is because we're operating at full employment. There's not going to be a lot of downward pressure on inflation when the economy is operating at a very high level of resource utilization, which is where we are today. I think the other thing is something that Chair Powell touched on yesterday. It looks like monetary policy is a lot closer to neutral than what a lot of people thought a few months ago. The fact that the economy continues to grow at a trend growth rate at a time where the federal funds rates, higher than 4%, tells you that maybe monetary policy isn't actually very restrictive at all. And so I think the prospect for further rate cuts has diminished considerably.
For the rest of the year, potentially, especially given the political uncertainty?
Well, potentially. I mean, the other issue we have, obviously, is we have a lot of, uncertainty about policy. We have uncertainty about what's going to happen to tariffs. We have uncertainty about deportations. We have uncertainty about fiscal policy. And so the Fed's also going to be reluctant to take big steps when they don't really know what the policy mix is going to be in the second half of the year and into 2026.
But we might not know what the policy is going to be the entire year. It might be like this for 4 years. So what does the Fed do? Just stay on pause forever?
Well, Powell basically said that the Fed would cut if the economy slowed sharply or if inflation came down. I think it may not be quite that simple. It may be that you only cut if the economy slows down. I could see inflation moderating further, the economy staying strong, and in that situation, what's the motivation for cutting rates at that point? So I think this, one or the other might turn out to be that you actually need not just a fall in inflation, but you also need a substantial slowing of the economy.
Bill, I'm also curious about the x-axis at a time when we're talking about inflation expectations over the next 2 and 5 years creeping higher, even though inflation expectations over the next 10 years are actually going down. This idea that over the longer term it will suppress growth. How does the Fed respond to that, given that they have been patient with the idea of inflation taking a longer time to get to that 2%, but at a certain point a long time becomes forever?
Well, you're absolutely right. I mean, every year you spend above 2%, there's more risk that inflation expectations, which have been well behaved up to now, finally start to become unanchored. And I think when the Fed looks at the effects on tariffs on the economy, they are going to be very focused on whether those higher prices caused by higher tariffs are actually feeding into inflation expectations. If they do, that'll make the Fed more cautious. If they don't, the Fed will be focused on the growth impacts of higher tariffs, slowing down the economy. So I think whether the Fed can look through the tariff increases in terms of their effect on prices will depend very importantly on what happens to inflation expectations over the next year.
Hey, Bill. Thanks for your time this morning. Looking forward to that second day of testimony a little bit later this morning as well. The former New York Fed President, Bill Dudley, there on the latest. With us around the table, David Kelly of JPMorgan Asset Management. David, you've had 5 minutes. What jumps out for you?
It's not as bad as it looks at first glance, because
Why?
the things that bumped higher are three of the flakiest numbers in the CPI. One of them was that shelter increase at 0.4%. We saw lodging of 1.4%. If you actually look at owners equivalent rent and rent, they were up 0.3. So it was a big increase in lodging. Well, that's not a big deal in April, but it just bounces a lot. If you look at airline fares, they were up, I think it was 1.4%. That's part of the core CPI issue. And then our old favorite auto insurance suddenly jumps 2%. And those three numbers are very volatile. The government does not measure them very well. So I don't think that changes the overall thesis that inflation is basically under control. But I certainly agree with the analysis that this is no reason for the Fed to move in interest rates. There's nothing in this report which says we need to have lower interest rates.
Does Chairman Powell have the luxury of making the same argument in about 90 minutes' time on Capitol Hill?
He should. You should stand your ground for honest analysis. I know it's easier to come up with a bumper sticker that inflation is high, but good economics, good central banking requires you to analyze the numbers. And when he does look at this, he'll say, look, there are some special factors here. And don't throw things at me. There are some special factors which bumped up the number this month. And in a few months' time, maybe even next month, you'll get a flip on the airlines and the hotels, and suddenly you get a better than expected number. They shouldn't overreact to this. But at the same time, they say there's nothing here which says that inflation is cooling.
I keep thinking about Steve Rasciuto and how he talks about how you can exclude this and exclude that, and you guys tend to fight over this. Yeah. But at the end of the day, it really is a rate that has been very sticky. Are you saying it's okay for it to be a little bit sticky if it's at 3% and not 9%, and it's okay to just sort of accept a somewhat higher benchmark inflation rate?
Yes, because if you look at it, the shelter issue really is very important, the owner's equivalent rent. Shelter is still, I'm not sure it's on this one, it's a 4.4% year over year. It was 4.6%. And so it's coming down, but it's coming down so slowly. But we know it's going to keep coming down. So all we know is eventually, the core of the inflation rate is eventually going to come down from 3% to 2%. We know that's going to happen. It didn't happen this month. And there's no reason for the Fed to move quickly, particularly given all the policy uncertainty.
David, appreciate your time as always. David Kelly there of JPMorgan Asset Management. Joining us now to extend the conversation, Mohamed, El-Erian of Queen's College, Cambridge, on the latest inflation data with equities lower and bond yields higher. Mohamed, first question to you, sir. Just how high is the hurdle to hike interest rates at the Federal Reserve? And does this conversation get started after a print like that?
So I think it will get started in certain segments of the market. It will not get started within the Fed. And you know what? You've heard me say this over and over again, John. If the inflation target is truly 2%, then we would be talking about hikes. We wouldn't just be talking about postponing cuts. Look, there's three things that are very clear from these numbers taken at face value. I'm going to come back to the face value qualification. One, they are hotter than what the Fed seems to expect given its signals, and they're getting hotter. Second, and this is where I differ with David a little bit, they are consistent with a whole host of other data points. This is not some outlier. They are consistent with what we've seen in other places. And also, they are consistent with the hypothesis that companies and other segments of the population are much more sensitive now to actual and expected cost increases. This is not a repeat of 2021, where you have an unanticipated inflation and people don't adjust quickly. This is a different economy.
So, Mohamed, are you suggesting that this economy is more inflation prone now than it was several years ago?
More inflation sensitive now than it was before. But where I agree with David, and this is a conversation that the Fed doesn't want to have, is that it's okay to have slightly higher inflation for now. You don't want to pull the rug from under U.S. exceptionalism. There's already a lot of uncertainty in the environment. Finally, John, the face value qualification was important because not only, as Mike pointed out, do we have the annual updates to all sorts of measuring things, but we also have the impact of the wildfire. And we simply don't know what the net effect is. But at face value, this is certainly not good news for the Fed, and the bond market and the equity market is reacting accordingly.
Mohamed, there are two aspects to this. On one hand, you can say this truly is a more inflation-prone market, and especially with companies more able and willing, like Coca-Cola, to pass along price increases, you could see a spike upward. So you should respond as a Federal Reserve to tamp down that inflationary pressure. And on the other hand, you're saying that the Fed should be patient because 3% inflation might be okay as long as it keeps going downward. Which is it? What is it appropriate to respond?
So it goes back to two issues. One that Powell is finally willing to talk about, and the second one that he doesn't want to talk about. The first one is what is the neutral rate? And he said yesterday that the neutral rate had meaningfully moved higher. The other one is what is the right inflation target? And that's the one he doesn't want to talk about. My hope is that this Fed will understand that if it could, and I understand why it couldn't, if it could talk about what is the right inflation target for an economy going through massive structural change, it would not be so obsessed with 2%. It would be flexible. It would target a range. So look, Lisa, it can be both. It can be that you should tolerate slightly hotter inflation prints, assuming that expectations remain relatively stable. And then you should promise us 2% down the road, but please don't target 2% for any time soon.
Mohamed, I'm struggling with the idea that the average inflation might be 3%. But Anne-Marie's eggs are 15% higher. Or, you go to fly to a popular route and suddenly it's 20% higher. That there are select pockets of inflation where companies see they have the ability to kick up prices in a way that maybe they weren't at a time 5 years ago when this was a less inflation-prone market. Does that raise concerns about longer term how much this could affect consumer confidence, especially at the lower end of the consumer scale?
So I think there's two things. Eggs is, like David said, that is a supply shock. Very different from higher prices for something where the demand is very high and the supply is inelastic. So, these two things are happening, but they're economically very different in terms of attributes. And that's the reality of an average inflation rate, is you have things going up very high and things going very low. The key thing to remember, at least what I look at, is the bet that the Fed and others were making is that service inflation would come down fast enough to offset goods inflation that is no longer going down, no longer going negative. Now what we're seeing is goods inflation is starting to pick up and service inflation hasn't come down fast enough. And I think that is a nature of the economy that we're functioning in right now.
If that's the nature of where we are right now, was it an error, a policy error for the Fed to cut 100 basis points?
And Marie, I believe that this Fed has no strategic anchoring. It is a ridiculous sequence that we've had. In July, there's no need for a cut. In September, there's need for a jumbo cut of 50 basis points. And not much has changed in between. Then we come to the next two and we are recalibrating, meaning we're getting down to the 25, regular 25. Now suddenly there's a huge discussion. Are we skipping? Are we pausing? There is no meaningful forward policy guidance coming from this Fed. And that is the mistake. That is the big, big mistake, is that they are just incapable, it seems, certainly unwilling, but it seems incapable of taking a strategic view of where the economy is going. They have been so burnt by their huge mistake in 2021, where they did take a strategic view, but they took the wrong strategic view, that they don't want to take any strategic view. So look for the Fed policy not to act as an anchor for this economy, but to fuel volatility further. And I think that is the basic problem we have right now with this Federal Reserve.
Mohamed, though, is this the Fed's fault in terms of what's going on right now, or is it just because they're dealing with a tremendous amount of uncertainty because they don't have clarity on some big policy issues in Washington?
Well, what I just said predated the great uncertainty in Washington. It predated it. So the Fed has a problem. But you would hope that when you would look around and companies look around about in this uncertain world, that they at least think that there's one bit that provides the anchor. And the Fed is not doing that. So whatever volatility is in the system right now, the Fed will amplify it. And that's not what it should be doing. And that's not what forward policy guidance is all about. But if you are excessively data dependent, you will amplify it.
Mohamed, Adam Posen, the Peterson Institute, thinks the next move is a hike. Torsten Slok, Apollo, has made the argument on this program a number of times, thinks potentially the next move is a hike. When you think about the next move, and you know what the next question's going to be, is the next move still a cut, or is it a hike?
If they believe in that 2% inflation target, the next move would be a hike. I think they will tolerate high inflation without telling us they're doing so. They're just going to keep on promising us that everything's going to be fine. And I think that we are going to be pausing the pause button is going to be on a lot longer than what the market has been expecting.
Do you think that should be a feature of today's conversation of day 2 on Capitol Hill in front of the House Financial Services Committee? Is this committee tacitly accepting a higher inflation rate, an inflation rate that they shouldn't be targeting?
This committee should be having a very detailed talk about monetary policy, and it should be talking about the different scenarios that are facing the economy right now, and what is the role of monetary policy. That is what it should do. But, depending on your sports, Chair Powell is in the game of either sidelining difficult questions or punting on difficult questions or ducking and weaving on difficult questions. He doesn't want to make news. He already made some news yesterday that I don't think he was comfortable making. So even if you get the questions, you're not going to get the answers.
Mohamed, putting together what you're saying, if this Fed does want to tolerate a higher inflation rate, is this neutral? Not necessarily any distance at all from neutral.
So you've heard me say this again, and that's because I focus on the structural element of this economy. We are very near neutral. We may be at neutral already. The economy has fundamentally changed from what it was in the last decade. And that's because the supply side has fundamentally changed. So yes, I've been saying this for a while. Okay, we are very close, if not at neutral. And I heard Chair Powell yesterday say that, for the first time he said this, that the neutral rate has moved up meaningfully since in the last few years.
So, Mohamed, just a final question then, with that in mind, and that has implications for the front end of the curve. What would this mean from your perspective for the bond market going forward from here? The shape of the curve, how things look compared to how they looked a decade ago?
So the front end and up to about 4 or 5 years is easier for me than the long end. And it's easier for me because I think the market is gonna move to the expectation that we're not gonna get a cut for quite a while. The long end, John, is really hard. You have a massive tug of war right now in the big 5. Deregulation, fiscal, both on the expenditure side and the revenue side, trade, immigration, and what's the fifth? And I'm missing a fifth one. I'll think of it in a minute. So those big 5, John, are not clear how they're going to net out yet. And that's going to impact the long end in a meaningful fashion.
Mohamed, this was a clinic. It always is. We appreciate your time, sir. Thank you. Mohamed El-Erian there of Queen's College, Cambridge, on the latest inflation print.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.